Hey Bowtie Nation, Joseph Hogue here with 7 penny stocks up an average 85% in the last 3 months as the market realizes their true potential. In fact, 3 that I recommended just 2 months ago are up 115%, with one up 200% in that time. But the 10x potential, that 1000% return upside on these penny stocks, means it's not too late. I'll reveal the 7 penny stocks to buy, why they're up big, and why they should be in your portfolio. I want to get right into these because that upside has been insane. I bought shares and highlighted Innodata, ticker INOD, in that September video, with the stock now up 201% in just 2 months. 200% return in 2 months. I'm not saying rush out to sell your furniture so you can load up on these stocks, but maybe keep an eye on your couch's resale value. And okay, now before the troll brigade rushes to the comments to tell me I'm batshit crazy for highlighting a $45 stock as a penny stock, remember, stock price means nothing here. What's important here is the company's size, its growth, and that potential. At just a $1.3 billion market cap, the value of the company shares here, Innodata is tiny compared to others in its space, like $13.9 billion EPAM, and minuscule next to $194 billion IBM. So capturing just a fraction of its market with a 30% annual growth, revenue growth that IBM could only dream of, that is what these penny stocks are all about, and could mean Innodata has 10x and higher potential. This company is a picks and shovels penny stock in the generative AI theme with data solutions that feed into AI models. From data duration, transformation, and consulting, the company enables generative AI to work for its customers. Revenue is expected up 59% this year and 30% next to $213 million. In fact, that revenue growth forecast has been upgraded from $177 million since I did the previous video, and unlike a lot of these penny stocks you're going to see, Innodata is already generating positive earnings. Nation, that is like the holy trinity of penny stock investing. To find a company in a high-growth theme like AI that is growing revenue by a strong double digits, 20% and more a year, that is already producing positive earnings and cash flow, I'm going to show you how to find these facts later in the video, but when you do, you load up. What's surprising, even after the big move this year, is the stock isn't terrifically expensive on next year's revenue numbers. It's at 13 times on a price to sales right now, which is getting a little high for my taste, but if we take the market value of $1.33 billion and then divide by next year's forecast of $215 million revenue, we get a price to revenue of just 6.2 times. Not bad for a growth stock. Our next stock is up 180% in less than a month, but I also want to get your input on this. You know, we love us some dividend stocks here on the channel, and those cash flow kings will have you retired and relaxing in good time. But these penny stocks, that is yacht money, but also the kind of risks that's going to make you want to jump overboard. So let me know in the comments below, which do you like better, those penny stocks, even with a little more risk, or maybe a little safer strategy in dividend stocks? Porch Group, ticker PRCH, is one we haven't highlighted before, but stick around because I've got another recommended in September that's up double since then. Porch is in 2 segments, homeowners insurance and the newer software and services platform to over 25,000 home services companies, so your inspectors, mortgages, and title service agents and others. The insurance segment still accounts for 72% of revenue, but it's in that platform segment that I think the real opportunity waits. Revenue is sluggish in insurance, but the company is leveraging that efficiency to drive earnings that almost doubled last quarter from the year before. Shares are up 180% just since late October, mostly on a change in its structure to a reciprocal insurance structure, where the policy holders own the insurance segment, and the larger company just takes a commission and fees on that, a more profitable structure for Porch. And I think this is where we see that opportunity. The insurance segment isn't a growth industry, with total revenue only expected up 4.7% this year and down slightly next. Now the company is cash flow positive, which is important. The business is generating that cash flow from insurance, even if net earnings are negative. So what I think, as we see the company shift its focus to that more higher growth software services platform, you're going to start to see revenue growth increase, and the insurance segment is just going to be that dependable cash flow from those fees. At $325 million market cap, it's as cheap on a cash flow basis and still a tiny company with potential. This next one isn't a stock, but could be an even higher return. Nation, deregulation and changes to the SEC could mean we're coming into an IPO boom we haven't seen since the late 90s. All you out there in the nation know I come from that world of venture capital, analyzing and investing in these pre-IPO startup companies. After real estate, that's where I spent most of my professional career, and well, maybe I'm biased, but for my money, there is no better place to invest for returns and the thrill that you get. It's how Peter Thiel made over 4,000%, 40 times his money as an early investor in Facebook, and how Elon Musk made his first billion with PayPal. It's also why I'm always on the lookout for great investing platforms in that startup space, letting you in on these types of investments before they issue stock. And I've just found one that offers more deals than any I've seen. Link2 gives you access to high-growth startups like Anthropic and its AI model Claude, one of the top 3 AI models, along with ChatGPT and Gemini. You can invest in digital assets platforms like Ripple, Elon Musk's SpaceX, and his XAI startup. And the best part is, this is one of the most accessible early-stage platforms I've seen, with a minimum investment of just $2,500. Signing up takes less than 5 minutes, and you're going to be able to get a referral code to make $1,000 anytime someone you know signs up. In fact, from the platform recently, I highlighted Anthropic as a pre-IPO stock that I'm buying. Anthropic has already had 7 rounds of funding, raising almost $4.6 billion and valuing the company at $45 billion. That is far from penny stock status, but this company is still in its infancy and has that growth for the returns that we want to see. Anthropic's Claude AI model is seen as one of the top 3 best LLMs, along with ChatGPT, which is owned by OpenAI, Llama, which is Meta, and Gemini, which is Alphabet. The model has been especially successful in the legal space, with the latest iteration scoring a 76% on the bar exam. Now, the downside here right now is that it's only open to accredited investors, so look for the special invite link I'll leave in the description or scan the QR code here to see if you qualify. BigBear.ai Holdings, ticker BBAI, is another one I highlighted in September and one of my favorite themes within AI, helping companies make sense of the overload in data. They help companies organize and visualize their raw data to turn it into actionable insights. This is key and really the first step in artificial intelligence. So just managing all that data collected and then being able to make sense of it. That's helped BigBear grow its customer base and a $206 million backlog for revenue. It's also produced some major wins recently, including exclusivity with L3Harris and a $32 million award across 3 contracts with the U.S. Army, a relationship that has grown 235% in the last 3 years. Now, expectations are only for 12% revenue growth this year, rebounding to 16% next, and this is another one that has been upgraded since September. Analysts now expect revenue to come in at over $200 million next year. Now, BigBear is still operating at a loss and a negative cash flow, so it's not the trifecta we saw in Innodata, but the company has over $72 million in balance sheet cash to see it through while that revenue and earnings grow. Folks, that's another key here in penny stock analysis. One of the first places I look when analyzing startups as a venture capital analyst. Cash is like oxygen to small companies. As long as it has that cash, it can breathe, making the moves it needs to keep growing and to its potential. The stock is up 30% since highlighting it in September, and at just $490 million market cap, it's cheap here at just 2.6 times revenue. Even cheaper if you consider that $200 million revenue expected next year. Sify Technologies, ticker SIFI, is up 42% in the last 3 months, and still a strong growth pick in the Indian tech revolution. The company is the largest information services provider in the country, offering cloud connectivity and data center services. A lot of the growth that we're seeing lately is on those same themes that we're seeing here in the United States. Just as that data center boom is building here, the same thing is happening in India, and Sify is the go-to in the industry. CapEx investments in Indian data centers jumped 12x in recent years, with more needed as the company's IT connectivity grows. Sify expects to see another 11% annualized growth in data center spending through 2028, and is also benefiting from growth in its cloud services. Revenue grew at 23% pace last year and is expected to top 40% this year as the company kicks into that growth mode. Earnings are the big one here though, with profits expected to triple this year to 6 cents per share, and then go 4x next year. Now, as a foreign stock, you'd expect it to trade more cheaply, but shares here are priced at just 0.5 times the company's revenue. That is very cheap for this kind of growth. Alphatec Holdings, ticker ATEC, at $1.3 billion market cap, does one thing, and it does it really well. The company is integrating its technological advances into spinal surgeries for better and more durable outcomes. Just its current procedures are a market size of over $2 billion globally and $1 billion here in the US because so many of those spinal surgeries have to be revised. As high as 1 in 3 deformity surgeries have to be revised within 2 to 5 years. ATEC has produced amazing growth, taking market share from peers and booking 36% annual revenue growth to 2022, launching an average of 9 new products a year. Its 2025 goal is to $555 million revenue, and just as important, to hit $80 million earnings with positive free cash flow. Analysts think it's going to beat that this year with a $605 million in revenue, and while it's still GAAP income negative, that 25 and 20% annual revenue growth with improving profitability is expected to take it to net income from a loss of $1.54 last year to just 65 cents a share next. Their shares are up 50% in just the last 3 months and still not expensive at a price of just 2 times this year's expected revenue, but the reason is likely in the cash flow statement. And the company is still investing heavily in its R&D and its technologies, with over $100 million in negative investing cash flow over the last year, on top of the $80 million in operational cash outflow. The cash on hand here of $81 million isn't enough to cover the company, and it's going to have to raise cash through debt, probably a dilutive convertible as it grows. Shares of Vicarious Surgical, ticker RBOT, are up 33% since recommending the company as one of my favorite AI plays in healthcare in June, and are up 67% in the last 3 months. Vicarious thinks it has an advantage and a unique decoupled design to robotic surgery that is going to help make procedures less invasive. The company's proprietary design decouples actuator arms on the robots to increase range and precision of movement. So it's starting from that point and hoping to build on it with its AI to reduce errors and accidents in surgery, putting as much of the procedure on autopilot as possible. That is a big goal and would help it grab market share in the $150 billion surgical robotics market, but I don't want to underestimate the risks here. That's because this is still a pre-revenue company with its first clinical patient not expected until next year and years outside of meaningful revenues. Vicarious has signed key partnerships with leading providers like HCA Healthcare that should help keep a development going on, but it's burning through about $14 million in cash each quarter, with only $39 million in balance sheet cash as of the most recent report. And that means it will definitely need to dilute existing shares through a convertible offering and debt. That's typical for these kinds of venture capital startup investments that I used to work in as an analyst. It's high risk, high reward, but you need to give it time to grow into that potential. This next penny stock has more than doubled, up 112% since highlighting it just 2 months ago, but if you want to see that full list, the 10 penny stocks I bought $1,000 each up an average 35% in that time. Make sure you check out this video next with the card in the corner. Duos Technology Group, ticker DUOT, was one of the smallest companies in that prior list, up 112% since. It's still a tiny company at just $38 million market cap. Now, as I highlighted in that previous video, this one is very thinly traded at just 39,000 shares traded on an average day, so the swings up and down can be monstrous. Nation, do not get scared out of your penny stocks when they drop, because they will drop, but just like we've shown in our penny stocks list, ride these higher long term, and you can see triple-digit returns. Duos operates a railcar inspection portal with AI capabilities to inspect trains in motion, generating high-resolution images in real time to prevent derailments. Duos has used the model across more than 40 use cases, claiming a 95% reliability rate and to have already prevented derailments. It could get a bump from the Railway Safety Act passed last year and hopes to expand that inspection technology across other transportation verticals in trucking and airlines. Analyst targets are for $5.75 a share, another 20% over the next year, but with this kind of growth, that could still be well short. Duos is still posting negative earnings, but expected to grow revenue by 63% this year and 83% next. Don't wait. Get ahead of the IPO boom, investing before the market on link 2 with a special invite link in the description, or click on the video to the right to see those 10 penny stocks I bought, up an average 35% already. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.